The 1920s roared with a vibrancy that seemed destined to last. America was brimming with newfound confidence, riding high on a wave of post-war prosperity. Innovation flourished, with automobiles and radios transforming everyday life. The stock market, once the domain of the wealthy, became a symbol of opportunity, beckoning investors from all walks of life. It was an era of unprecedented growth, a time when fortunes were made, and the American dream seemed within reach for everyone. There was a palpable sense of excitement in the air, a belief that the good times would never end. From bustling cities to rural communities, the spirit of optimism was contagious. Americans embraced consumerism, indulging in new products and experiences. The Jazz Age was in full swing, and a sense of liberation and exuberance permeated society. The stock market, with its promise of quick riches, became the focal point of this national euphoria. It was a time of unparalleled prosperity, but beneath the surface, a storm was brewing. The allure of easy money proved irresistible. Speculation ran rampant, fueled by the belief that the stock market would climb indefinitely. Investors, both seasoned and novice, poured their savings into stocks, hoping to ride the wave of prosperity. The Dow Jones Industrial Average, a key indicator of the market's health, soared to dizzying heights. Every upward tick seemed to confirm the invincibility of the market, further fueling the speculative frenzy. Amidst the revelry, few paused to consider the sustainability of this unprecedented growth. The stock market, once a reflection of the real economy, had become a casino, driven by speculation and fueled by borrowed money. The stage was set for a dramatic fall, a fall that would have far-reaching consequences for America and the world. The allure of the stock market proved irresistible to millions of Americans. They were enticed by the prospect of quick and easy profits, fueling an unprecedented surge in stock prices. A particularly risky practice, margin buying, became increasingly common, magnifying both potential gains and losses. This system allowed investors to purchase stocks with only a fraction of the actual price, borrowing the rest from their brokers. It was a high-stakes gamble, one that promised to amplify returns but also carried the risk of devastating losses. With margin buying, investors could control a larger volume of stocks with a smaller initial investment. This leverage could significantly amplify profits if stock prices rose as anticipated. However, this practice was a double-edged sword. If the market declined, even slightly, investors could face margin calls, demanding they deposit more money to cover their losses. Failure to meet these calls would result in the forced sale of their stocks regardless of the price. This system of buying on margin created a dangerous illusion of wealth. It inflated the value of the stock market beyond its true worth. As investors leveraged their positions to the hilt, the market became increasingly detached from the real economy, driven by speculation rather than fundamental factors. This disconnect between the market and the underlying economic realities would have dire consequences when the bubble eventually burst. The widespread use of margin buying increased the volatility of the stock market. It magnified both the speed and magnitude of price movements, making the market more susceptible to sudden and dramatic swings. This inherent instability set the stage for a catastrophic crash, one that would shatter the illusion of prosperity and plunge the world into an economic depression. Beneath the veneer of prosperity, warning signs began to emerge, signaling trouble in the American economy. While the stock market soared, other sectors showed signs of weakness. The agricultural industry, a cornerstone of the economy, struggled with overproduction and falling prices. Farmers, burdened with debt, faced an increasingly precarious existence. Despite these warning signs, the speculative frenzy in the stock market continued unabated. The rapid expansion of credit, while fueling economic growth, also led to unsustainable levels of debt. Consumers, enticed by easy credit, accumulated large debts to purchase automobiles, appliances, and other consumer goods. This debt-driven consumption masked underlying economic weaknesses and created a fragile foundation for continued growth. The warning signs were there, but they were largely ignored or dismissed as inconsequential. Industrial production, another key indicator of economic health, began to slow down. The construction industry, a major driver of growth during the 1920s, also experienced a decline. These warning signs suggested that the economic boom was losing steam, but the euphoria in the stock market continued. Investors, blinded by their pursuit of quick riches, remained fixated on the upward trajectory of stock prices. Despite these clear signs of an impending crisis, policymakers and economists failed to grasp the gravity of the situation. Some dismissed the warning signs as temporary blips in an otherwise healthy economy. Others believed that the market would correct itself without government intervention. This complacency and misjudgment would have devastating consequences when the bubble finally burst.